Welcome back, everyone. Guess what? We are already in risk response. Just in case you need further proof that we are indeed making good progress, allow me to show you the phases of the audit process that we used as a guide in our discussion. And we have already tackled pre engagement activities. We have also already talked about audit planning and risk assessment procedures, all of the concepts on materiality and what PSA 315 has to tell us and what exactly are risk assessment procedures. And we found out that these are actually the IIOs, inquire, inspect, observe, together with analytical procedures. And now we are ready to move on to the next phase. From the risk assessment stage of the risk based audit approach, we are now ready to talk about risk response. Now, don't get me wrong, all of the relationships that we talked about a while back, when we talked about what happens to the acceptable level of detection risk if the risk of material misstatement is high. Of course, we said the acceptable level of detection risk will be low. And of course, we said if the acceptable level of detection risk, if the risk that you are willing to accept is low, then the stricter you become. And the stricter you become, we take a look at the effect of this on nature, timing, and extent. The stricter you become, the more effective procedures you will choose, the more that you would test or perform year end procedures, and the larger the sample size that you would use. That, my friends, is already the start of risk response. So, to set the expectations, again, we are simply providing an overview. This is not yet the detailed discussion of how and when these procedures will be performed in view of the particular transaction cycles. This is not yet the time. What we're simply going to do here is to give an overview of the auditor's evidence gathering procedures. And with that, let's take a look at the different audit procedures that you will be encountering all throughout your external FS audit journey. Of course, we will start with, and we have already gotten to know of this procedure, RAP, or Risk Assessment Procedures. Risk Assessment Procedures are as defined by PSA 315, 2019 revised. This refers to the audit procedures designed and performed to identify and assess the risks of material misstatement, whether due to fraud or error at the financial statement and assertion levels. Again, we get to recall that there is now a shift in the focus, whereas before, the main purpose of risk assessment procedures is simply to obtain an understanding of the entity and its industry and accounting and internal control systems. Now, the main purpose is to identify and assess the risks of material misstatement. That is why we talked about inherent risk and control risk, and how, since these two cannot be controlled, we are simply going to assess them. And whatever our assessment is of inherent and control risk will eventually affect our FAP. FAP, FAP. What does FAP mean? Further audit procedures. And our further audit procedures could either be test of controls or substantive procedures. Test of controls would refer to the audit procedure designed to evaluate the operating effectiveness of controls in preventing or detecting and correcting material misstatements at the assertion level. Now, tests of controls are a curious thing because they are not required to be performed. Unlike risk assessment procedures and substantive procedures, tests of controls are not required to be performed. In fact, there are only two instances, I repeat, there are only two instances in which tests of controls will be performed. The first instance or the first scenario is, well, the most popular scenario, and that is the auditor tests the controls if the auditor intends to rely on the controls. And how would we know if the auditor intends to rely on the controls? Well, it will be on the basis of the preliminary control risk. And the preliminary control risk is actually arrived at when the auditor performs risk assessment procedures. And once again, when the auditor performs RAP or risk assessment procedures for control risk, the auditor is focusing on design and implementation. And if the auditor believes that the controls may be relied on and the auditor intends to rely on them, then the auditor tests the operating effectiveness of the controls. And this test is what we call test of controls. So the first instance is when the auditor intends to rely on the controls. The second instance, when an auditor will perform test of controls, is in the case of RSPAs, RSPAs. What are RSPAs? These are risks for which substantive procedures alone. That's why it's RSPAs. R for risks, for which, S substantive, P procedures, A alone. Risks for which substantive procedures alone cannot provide sufficient and appropriate evidence. In other words, even if you perform a completely substantive approach, you still can't get sufficient and appropriate evidence, then by all means perform tests of controls as well. These would usually apply to highly automated, repetitive processes with little to no manual intervention. So, those are tests of controls. Again, they are not required to be performed, only required when you intend to rely on the controls and in the case of RSPAs. And then, of course, we have substantive procedures. These are audit procedures designed to detect material misstatements at the assertion level. Now, we might recall what our audit opinion sounds like, right? We give an opinion as to whether the financial statements are free from material misstatements. And so, therefore, in the true fashion of the audit opinion or the audit report, substantive procedures must then be required because they are the actual procedures that would detect these material misstatements at the assertion level. Now, substantive procedures may comprise what we call test of details, and test of details may either be test of details of classes of transactions or test of details of account balances and disclosures. So just imagine your T account. If you can imagine your T account, there's a debit side and a credit side. If what you are testing are the debits and the credits, then that is a substantive test of details of transactions. But if what you are testing is the ending balance, then that is a substantive test of details of balances. There is also what we call substantive analytical procedures. So just to draw out the difference in the types of substantive procedures, when you talk about test of details, these involve the examination of items or details that comprise an account balance when you test the balances or a class of transactions when you test the transactions. Take note that every audit involves the performance of test of details. We said a while back, risk assessment procedures and substantive tests are required. In the case of substantive tests, test of details are required. In contrast, when we talk about substantive analytical procedures, these are analytical procedures applied specifically for the purpose of testing the reasonableness of account balances and identifying significant fluctuations or differences which may require further audit investigation. Do you remember in our previous video that we said analytical procedures are so widely used? They can be used in planning, testing, and completion. This one right here is the analytical procedure performed in testing. And take note that substantive analytical procedures are not required. Okay, so substantive analytical procedures require less time and effort, but are also less reliable as compared to test of details. So if we're going to make our notes, if you are making your notes right now, then the types of audit procedures would have been RAP and FAP. And under FAP, you will have TOC and substantive tests. Between RAP and FAP, we already know that RAP is required. Let's now take a look at FAP, and you have TOC versus substantive test. Between the two, we know only substantive tests are required. Now, substantive tests are further divided into substantive test of details and substantive analytical procedures. And of the two, only the substantive test of details are required. Now, substantive tests of details are also further classified into substantive tests of details of transactions and substantive tests of details of balances. So those, my friends, are the audit procedures of the auditor, of course, and this will be used to respond to the risk assessment of the auditor. But don't worry, we still have a lot more exciting things to talk about when it comes to evidence gathering, but we will have to park that for a different module so as to give it its appropriate time in the spotlight. All right. So again, for now, we're simply giving the overview. So we're done as well with risk response. Let's now jump on to the next stage of the risk-based audit approach, and that is, of course, conclusion and reporting. So once we have already performed risk assessment and we have responded to the risks, assuming we have already gathered sufficient and appropriate evidence, we go to the completion part of the audit, completing the audit. After all of the previous steps, you will now see here the third and final phase where analytical procedures may be performed, and that is, of course, in the final analytical procedures. We then remember that in this stage, the auditor uses the audited balances and does a final review for reasonableness and a final check if there are no more unusual or unexplained relationships. In case that as a result of the final analytical procedures, the auditor is still able to see unusual or unexplained relationships, the auditor may consider expanding his or her testing. This is also the phase where the auditor will perform other audit procedures such as reading minutes of recent board and committee meetings and obtaining management representation letters. This has now come full circle. Do you remember when we talked about engagement letters? One of the contents of the engagement letter is to make management know that there is an expectation from us that they will give us written representations. Here it is now. Upon completing the audit, we will obtain from management written representation letters. In addition, the auditor also makes final materiality judgments. As what we have mentioned, even when we determine materiality at the planning stage, that is not yet the be all, no, and the final. We are going to review it as our audit progresses, and upon completion of the audit, we're going to make final materiality judgments. This is also the phase where the auditor summarizes and evaluates the audit findings. This is also where the review of the working papers are done and the review of the FS presentation and disclosures for adequacy and, of course, the consideration of subsequent events. That is another interesting topic to talk about, but all in its right time. We will also be having a separate module for completing the audit. But at its most basic, at its bare skeletal, this is what will happen in completing the audit. And after the completing the audit, of course, we do get to issue the audit report. And I think you are already very well versed with the types of audit opinion. We will also have a separate module for this one. But just to provide an overview, the four types of audit opinions, of course, unqualified opinion, this communicates a favorable signal about the financial position, results of operations, and cash flows. But please take note, when we give an unmodified opinion, while we call this one the clean opinion, it simply means that the financial statements are free from material misstatements. A qualified opinion, on the other hand, communicates a favorable signal but with modifications. For example, you may wish to alert users that the FS are presented fairly except for the effects of certain accounting principles, such as, for example, except for accounting for foreign exchange transactions. Okay, so in other words, the FS is still okay, it is fairly presented except for. But this exception is not enough to overshadow the entire financial statements. And when we talk about adverse opinion, well, it communicates an unfavorable signal. Usually, this is issued when the conditions are appropriate for a qualified opinion, yet the issue leading to the qualification is so material and pervasive. In other words, the violations that have been noted in the client's financial statements have been enough to overshadow the fair presentation of the FS. An adverse opinion is kind of like saying the financial, not kind of like, but the adverse opinion is saying the financial statements are not fairly presented. A disclaimer of opinion, on the other hand, signals that an auditor does not express an opinion. This is kind of like the auditor's version of no comment. No? And a disclaimer of opinion is given, of course, when the auditor was not able to perform an audit owing to a material and pervasive scope limitation. Again, more of this when we reach our discussion on audit reports. But as early as now, allow me to clarify that while we are saying it gives a favorable signal, it is not a guarantee as to the future viability of the entity. It's simply an expression of the confidence that the financial statements are fairly presented, but it does not guarantee whether the entity is a good investment vehicle or whether it will continue into the future. All right, so no, our opinion does not cover that. We simply give an opinion as to whether the FS are fairly presented. And then, of course, once we have issued the audit report, we also perform post audit responsibilities, mainly looking into the activities involving debriefing, wherein it will consider events during the audit, analyze the activities within the audit, and produce recommendations. This is also the part where the members of the audit team could discuss as to what they have encountered during the audit and how moving forward to use that in the future audit engagements with the same client, if that client will still be your client. All right, so we go back to the slide and we do say we can put a check mark on the FS audit, client acceptance and audit planning. Now, in order to neatly tie everything with a bow, let's talk very quickly about direction, supervision, and review. I kind of like want to think about this as I'd like for you to imagine with me, like when you say direction, you are directing, you are giving instructions. So it's more of forward looking. Supervision is together with, okay, while the audit is being performed. You check on the team, you check on the engagement team. Review, of course, is once work is done, right? So you get to review their work. So when we talk about direction, it involves informing your assistants, informing the engagement team of their responsibilities and the objectives of the procedures they are to perform, informing them, instructing them, letting them know of matters such as the nature of the entity's business and possible accounting or auditing problems that may affect the nature, timing, and extent of the audit procedures with which they are involved. So direction is more of like instructing, informing, okay, the engagement team. Supervision involves directing the efforts of the team or assistants who are involved in accomplishing the objectives of the audit. In the case of supervision, it would involve, while there will still be instructing the assistants, keeping them informed of significant problems encountered, reviewing the work, and dealing with differences in opinion. All of these things happen while the audit is ongoing. And this is closely related to both direction and review. As you could very well see, it involves elements of both. There's still the instructing part and there's still the review part. The idea being that as the work progresses, you keep on checking on your team. A review is done, well, once work is done, it is done to consider whether work has been performed in accordance with the audit program. Remember the detailed set of instructions. Work has been performed and results obtained have been adequately documented, and this is where the importance of our working papers would come in. It is also done to consider whether all significant audit matters have been resolved. And we are reminded that we do not issue the audit report until and unless all significant audit matters have been resolved. Whether the objectives of the audit procedures have been achieved, particularly whether sufficient and appropriate evidence has been gathered, and whether the conclusions expressed are consistent with the results of the work performed. Now, what needs to be reviewed on a timely basis? Well, we do need to review the overall audit plan and audit program, the assessment of inherent and control risk, including the results of tests of controls if ever they are performed, documentation of audit evidence obtained from substantive tests, and the financial statements, proposed audit adjustments, and the proposed auditor's report. We do take note that in the case of the review, the work of a less experienced team member is to be reviewed by a more experienced team member. We also acknowledge that the engagement partner does not need to review all of the working papers. Of course, ideally the work of the junior staff will be reviewed by a senior staff, the senior will be reviewed by a manager, the manager's work will be reviewed by a partner, but as we all know, that is not always the case. There are some engagements where you'll be having a junior staff reporting directly to the partner, but the idea being that the work of a less experienced will be reviewed by a more experienced member, and the partner does not have to review everything. Okay, so guess what? That's about it. Good job, everyone, and we have thankfully finished this module, and I hope to see you all in the next one. I hope you are updating your notes right now. Again, please do not focus on memorizing the contents and etc., etc. So focus on the concepts, focus on an appreciation of the steps and what goes on into the steps. That is more important than the enumeration of the things that need to be included and whatever. All right. So, congratulations once again. Good job, and see you all in the next one.